Equity markets are pricing in an immaculate AI-driven recovery while completely ignoring structural breaks in the global supply chain. Look at Bank of America's April 26th publication. In the exact same document, the CIO desk overweights U.S. equities on AI resilience, while Claudio Irigoyen's Global Economics desk publishes a formal game theory model concluding the Middle East war will run longer than current market projections. No party has experienced enough pain to capitulate, yet the market is aggressively buying the assumptions of the desk that generates fee revenue and entirely ignoring the one with the mathematical model. The dominant narrative assumes the recent ceasefire resolved geopolitical risk. It only paused the military escalation. It did not restore blocked physical supply lines. This maps Persian Gulf oil flows. Factoring in redirections, output is constrained at exactly 40% of normal capacity. 60% remains offline. With buffers approaching all-time lows, this constraint has driven Brent crude up to $105.33, erasing the ceasefire dip. For emerging market sovereign solvency, quarterly U.S. equity earnings are irrelevant. A structural 60% reduction in energy flow is the central variable driving import bills and fiscal deficits. This energy constraint is hitting vulnerable economies directly. India is currently absorbing two simultaneous independent economic shocks that invalidate the IMF's baseline projections. This chart tracks the compound shock. Brent crude has decisively breached the specific $100 per barrel threshold that accelerates domestic food inflation. This spike converges directly with newly confirmed meteorological data projecting a monsoon season failure. The Reserve Bank of India holds massive currency reserves of $697 billion. But those structural defenses were never stress-tested against an unpriced combination of collapsing energy supply and failing agriculture. The bank's dovish stance is becoming untenable. A second, silent structural risk is accumulating in global currency markets as the US dollar to Japanese yen pair extends past 159.38. This visualizes the trap. The US-Japan interest rate differential widens artificially because the Bank of Japan and Federal Reserve are extending policy holds. These holds sustain the immediate carry trade, but strip the market of any warning catalyst for an eventual unwind. The historical record is clear. When an overextended yen carry trade reverses, it happens without warning, transmitting instantaneously into emerging market credit spreads as a systemic contagion event. The data dictates a precise trade architecture. Investors must actively fade the broad, unhedged emerging market index rally that assumes an absolute geopolitical resolution. On the long side, overweight Latin American hard currency commodity exporters. This cohort directly and mathematically benefits from the ongoing Hormuz supply blockade. Conversely, maintains strict caution on energy importing frontier sovereigns across Asia and sub-Saharan Africa. Explicitly fade India's local currency duration. Prioritize short-dated hard currency credit. A persistent safe haven bid for the US dollar places recent local currency gains at extreme risk of reversal. In an unresolved conflict where the base models indicate prolonged attrition, pricing in an absolute certainty is the most expensive position a fund can take. Access the unredacted brief to execute the blueprint.